Everybody, and welcome back to this Learn to Trade Smart Money Concept series. So today this is going to be episode 3, which is actually the first video within step 2 of the 3-step approach to the markets. I can flash an image on the screen now which demonstrates what the 3 steps are so that you understand what it is I'm referencing. Now, the first 2 episodes that we've just had out before this one, they went over everything we need to know about market structure and creating a bias. So that is step 1. The first video covered the structural laws, or the more basic concepts that we needed in order to advance to the more in-depth parts of that step. Similar thing is going to happen this time round within step 2, where we come to learn what the smart money is, what smart money operators are, who they are, and on top of that, the importance they have. That will be the first episode, or episode 3 here. Episode 4, what that will cover then is how all of that ties into points of interest in the market, what points of interest are, how we can identify them, how we can refine them, and then use them within that overall strategy of analyzing the markets and taking trades. So the first thing that we need to do is introduce smart money. Now what I'm going to be doing here is referencing the PDF, or the second PDF from the Beating the Banks e-course or online course. So I actually wrote a really nice piece about this on one of the first chapters in the course. So I'm going to try and reference that as much as I can. So the one main fact that I bring up when trying to introduce smart money, or the smart money concept, is this. So we have to understand that on average, there will be around $6 trillion traded through the forex market every single day. So within every 24 hours, we have $6 trillion traded through the market. Now, obviously, we know that the markets are open 5 full days every week. So what this means is that every single week, we have $30 trillion traded through the markets. So what that is, and 5 full days, represents 120 hours. So within 120 hours, we have $30 trillion that are passed through the market, and this is obviously on average, which may change. So that this means that on average, every single hour, so 1 hour, within an hour, on average, $250 billion is traded through the markets. Now, this is almost the equivalent of some of the richest people in the world's net worth. I think it's somewhat equivalent to Jeff Bezos' net worth. When I created this PDF, it was. I don't know how that may have differed since then. But let's just imagine that every single hour, Jeff Bezos traded his entire net worth in the market every hour for 120 hours straight. Now, that is just to put into context the vast amount of liquidity that is pumped through the markets. So now that we can try to comprehend the sheer size and the sheer mass of liquidity and volume of money that is traded through the market, we can introduce another fact. Now, what this means is that only around 5 to 10% on average of this liquidity that we've just discussed that's traded through the markets is actually people like ourselves, retail investors, or what we like to call dumb money. So the term liquidity is simply just a reference to money in the market, or just money in general. So when money is being pumped in, when we're executing positions, we are bringing liquidity into the market. So liquidity is just a reference to money. If a market is more liquid, there is more money being passed through that market. And typically, when a market is more liquid, it is more volatile, because more money in the market means quicker movement and more institutional control. Now, as we just said, 5 to 10% of that liquidity, so of that $30 trillion every single week, only 5 to 10% of that is retail investors or retail traders. Now, what that is accounting for, people like ourselves, small hedge funds, any businesses, sole traders, all of this. Now, the other 90 to 95% of this liquidity, so out of that $30 trillion every single week, understanding that 27 to 28.5 trillion dollars of the 30 is traded by smart money, or the institutions, which is a reference to the central banks and top hedge funds around the world who are just trading with unreal amounts of liquidity, who are trading with billions, even trillions of dollars, who are able to pump such vast amounts of liquid through the market every single day. Now, obviously, if we compare that to a retail trader, now let's say when we're getting into trading, most people may start, I don't know, on a £1,000 account, $1,000 account. Even on the higher end, when people are getting funded with a £100,000 account or $100,000 account through FTMO or any of these funding sites that you may use, that's still nothing compared to these institutions. Okay, let's compare 100,000 to billions, tens, hundreds of billions. Obviously, if a position is executed of such a high lot size such that it is taking billions out of that person's account compared to thousands, there's obviously going to be a completely different effect on the market when that position is executed. Now, when the smart money operators or institutions or composite man, each one of those is a reference to the same thing or the same idea, okay? Each time an individual executes a trade from that category, so a smart money operator executes a trade, they are executing a trade with such a high lot size that they can literally have an effect on the market. So the simple execution of their position alone is enough to change and move the markets. Now, because we know that the smart money operators provide 90 to 95% of the liquidity, and on top of that, there is a very few of them. So let's just say, even if we look at it from the composite man theory, which we'll get onto later, but the composite man theory is just imagining on a basic level that everything in the market is through the control of a singular person, a singular entity, a singular man. So let's just assume that every single move we see in the market is controlled by the smart money operators. Now, the reason why we can back that is because we understand that they provide so much liquidity into the market, they pretty much control when the market moves, where it moves to, and what the overall trend is. So because we can understand now that they have control of the market, because they have that much liquidity to play with, and in this game it is unfortunately just a case of who is the bigger guy, who has more money, who has more liquidity, is always pretty much going to win. Now what that means is that these central banks and top hedge funds that can execute positions that large are able to move the markets, because when they execute a position, for example a sell position, the simple execution of that sell position will introduce a lot of supply into the market. That is enough supply to tilt the supply and demand balance into their favor. Now what we understand is that any execution of a position on any side is going to affect the supply and demand balance, some a lot more than others. For retail traders like ourselves, we understand that every single retail trader around the world only still controls, let's say, 5% of the liquidity in the market, which basically means that millions of people out there who are inside of this category of retail traders are executing positions all the time, like tens of millions, if not even hundreds of millions of people out there who have tried trading in the past or are executing a position at the same time. Those millions of people who are executing a position are still not enough to cause as major of a move in the market as one single smart money operator. So one single smart money operator can outweigh millions, if not hundreds of thousands, of retail traders. So we need to get rid of that stigma that would say that, okay, a market is moving up because more people are buying into it than people are selling into it. It's not. The market is moving up because the smart money operators have decided the market needs to go up and have executed buy positions large enough to flip the supply and demand balance into demand's favor, therefore pushing price up. Now we'll obviously go into what supply and demand is. So I'm just wanting to quickly insert this clip within the video because I know that when I'm discussing things without much visual aid, it's definitely a lot harder to grasp the concept that I'm trying to underline. So this whole thing and the direction of the market, the speed and means of how the market moves is all dictated by the supply versus the demand balance. So as we put here, the supply and demand balance dictates the direction of the market. So when supply is greater than demand, so when there is more supply prominent in the market than there is demand, the market will then move down. Okay, so when supply is in control, we move down. When demand is greater than supply, so demand is outweighing the amount of supply that is in the market moves up. So when demand is dominant, that's when we see bullish structure or the market moving up. So we see at the bottom here, supply greater than demand, market moves up. Supply less than demand, market moves down. So let's just go across there. So I always use the example of the old school balancing scales that we use to measure things out. So this is going to represent the supply and the demand balance. Now, supply is representing the number of lots of selling power that is within the market. Demand is representing the number of lots of buying power represented within the market. So we see in this example, we're saying that there is 500 billion lots of selling power and 1 trillion lots of buying power. As we know, 500 billion is less than 1 trillion, so the market must move up because there is more lots of buying power in the market than there is of selling power. Now, what this means is that it is a constant battle between buyers and sellers. You know, most people's assumptions within the technical way of trading is correct. If there are more bulls in the market should move up. If there are more bears in the market should move down. But the fact that we introduced at the start of the video, the fact that the smart money operators and the institutions control the majority of the liquidity, it is actually those that can dictate the movement of the market because they are able to introduce enough lots at once to tilt this balancing scale to wherever they want. So for example, looking at this right now, if they're looking at this and they're saying, right, well, we don't really like the way that this looks. We want supply to be in control. We no longer want the market to move up. Instead, we want it to move down. What they would do is they would actively try to remove lots of buying power whilst introducing lots of selling power, therefore making this side heavier than that side. So we end up with something along the lines of this, where now we have 10 trillion lots of selling power in the market and only 2 trillion lots of buying power. In this case, supply is now outweighing demand, therefore the market must move down. Now, the more that one side outweighs the other, so we see that this is a ratio of 5-1, where as example, the one prior was a ratio of 2-1. So this structure, in which case demand is dominant and outweighing, so market would be moving up. So the bullish structure being created when the supply and demand balance is like this would not be as aggressive as the bearish structure created from this supply and demand balance, given that supply is in favor of a ratio of 5-1. So it's just the understanding that the market is a constant battle on this balancing scale of supply and demand. The smart money operators are constantly executing and closing positions of very high lot sizes, which is constantly adding and taking away from this balancing scale. So as you can imagine, this balancing scale is never still. It's never like this image, 10 trillion versus 2 trillion and staying that way for a long time. It is constantly, every single microsecond, changing. Positions are being opened, closed. Hence why the markets always seem to have a mind of their own, because it's never following a linear process when it comes to supply versus demand. This figure is always changing, and the ratio of which one compares to the other is changing itself. Therefore, structure will always be different. It will always be more aggressive, slightly less aggressive. All of these different things we see is all dictated by the supply and demand balance, and this is the tool the smart money operators use to push the market in their favor, because they can dictate and manipulate where this balancing scale lays. So hopefully going through with a bit of visual aid has helped you understand what all of this is, what supply and demand is, and I'll let you now get back to the video. But please just understand that core, simple concept of what supply and demand is. And that's going to tie into the fact that because we're talking about how many lots of buying power, how many lots of selling power, we're understanding that the smart money operators are introducing 90 to 95% of those lots of selling or buying power. Now we could have 95% of all positions executed in the market be buy positions. Therefore, 95% of all positions in the market are adding to demand, and only 5% adding to supply. So only 5% of all positions out there are sell positions, but the market could still be going down. Even though 95% of the positions executed are buy positions and therefore are adding to the demand in the market, we could just have 95% of those trades being trades executed by retail traders, and the 5% of sell positions have been executed by smart money operators. Now, of course, the smart money operators can literally execute one position and suddenly outweigh the 95% of retail traders out there who are all looking in the opposite direction. So we must understand that because they have that much money to work with, whenever they place a position, it's going to have a much more vast effect on the supply and demand balance, because they can simply add or remove hundreds of thousands times more lots than any retail trader could ever imagine. So hopefully now that makes sense and lays the foundation of what smart money is and how that concept makes sense, understanding that the smart money operators or the institutions simply control the markets because they have the liquidity to do so, because the simple execution of their huge positions is enough to affect the supply and demand balance in such a vast way. Okay, so the first thing and the first topic or subtopic we really go on to here is something called market manipulation. So we have to understand that smart money operators, they have extra information compared to what we see when we load up a graph. Now, what they know is that they understand and see the market from a standpoint of liquidity. Now, what liquidity means in this case, I know we were talking about at first, it was referencing money in the market. So if a market is liquid, there's a lot of money in that market. But in this case now, I want you to understand that now when we talk about liquidity, we're talking about regions in the market that hold value. Now, what that means is that in a market, when people are getting involved in any position at any point, where are they most likely to set their stop losses? Now, for me and for anyone else, I think the majority of traders will have their stop loss set above a swing high point or below a swing low point. That is because if we get involved, especially in bearish structure, and we get involved in a position, we're putting our stop loss above the high because we're expecting that high to hold and therefore to low to break. So it's obviously going to be a very productive and wise decision. For example, in this case, once we see price starting to break down, for us to get involved in a trade here, stop loss above that, take profit down there, because we expect that price should break that low and protect that high. Because why? Well, structure is bearish, so that's what it tells us. We know that it's much more likely for price to continue bearish than to break bearishness. Therefore, it's very likely that if we put our stop loss above a protected high, it will not be hit. On the flip side, if it's bullish. Now, because we know this, and because we know that the majority of traders will put their stop losses around or use swing points as reference to their stop loss, we know that at areas of swing points, there's going to be a lot of liquidity. Now, what that means, and maybe we can even see an example of this if we zoom down low enough. If you bear with me momentarily. Okay, so for example here, each one of these swing high points is going to represent regions in the market where stop losses have been set. So I'm going to draw on this time frame the majority of these swing highs. Obviously these are all a similar level, but we understand that people would have been getting involved in positions, sell positions all throughout this, because there's constantly lots of people looking to sell a market, lots of people looking to buy a market, people using different techniques, people looking at different time frames, people looking to trade different things. So we can understand that there's always going to be sellers and buyers in any market at any given point. So we understand that because there's so many different strategies, there's always going to be people executing positions, but still working around the swing point. So no, regardless of where those swing points are, they're still going to be important in terms of liquidity, because they're still going to be used as reference points for stop loss placement. So we understand that as price stuck within this range, and we were ranging across, and this is also the purpose of ranging markets consolidation. So that is a market phase that we know, a ranging market or consolidation actually has the purpose of building up liquidity in the market and clearing it through something called market manipulation. So something that we can actually see here, price spent a lot of time hovering in this region, and we can identify that through the use of a box and say that inside of this region of the market, we had a lot of liquidity. Why? Well, that's because thousands, if not millions, of stop losses were set above this point. Now, when a stop loss is hit, a trade is closed. When a trade is closed, we are removing money from the market. We are removing liquidity. We are removing lots of selling and buyer power. So we are removing or affecting the supply and demand balance. Now, the smart money operators have the purpose of doing this, of finding these areas of liquidity, if not creating these areas of liquidity, should we say, because we know that the smart money operators actually control the moves in the markets. So we're saying that they did this for a reason. We're looking at this and saying, well, why did the smart money operators decide to hold price within this range? It was so that people would get involved in positions. As we can see here, place their stop losses all throughout there. Therefore, we know that because there's a concentrated area of stop losses in the market at this region, there's going to lie a lot of liquidity. So the smart money operators know that if they push price through that, they are removing a lot of liquidity in the market. Now, the more liquidity they can remove, the more control of the markets they gain. But at a simple level, we can just say that the smart money operator's purpose is to make dumb money or retail traders incur losses. So the extra information that the smart money operators actually have is they will see on their chart where areas of liquidity lay. Now, they obviously have tools that show them exactly how much liquidity is where these stop losses are, so on and so forth. We unfortunately don't have the power to use all that extra information and have those tools available to us, but we can still understand that when we see a region of a lot of swing points together, we understand that there's going to be a lot of liquidity. Now, not only is this valid because of the fact that we know every single swing point, people will be using that swing as a reference to their stop losses, but also because we know a lot of retail traders who trade chart patterns, support and resistance, will be using this level as a level of support. We'll be using this as an example to get involved in short. And if we follow this structure, we can see that price was trading up. We technically had a break lower. This high volume push seems like a clear rejection from the level. We're breaking lower. We've even come back up to test that level of resistance. We're showing signs of falling down, creating a new lower low. So a lot of people think, right, level of resistance, there's a lot of confluence, and they would be right in their strategy, a lot of confluence for sell positions to be taken. But we know that the institutions are only doing this to build up more and more and more liquidity. So what they're going to do is they're going to fake a sign or fake using price action that this is a relevant area, that price is reversing from here, before ultimately deciding, okay, we've built up enough liquidity, let's now clear that. We see price then flows through, liquidity's been cleared, they have manipulated the market because they have manipulated everyone that was involved in sell positions within this into losses. Now, I actually wrote a sentence within this PDF that pretty much just says, the reason the smart money operators want to manipulate people out of the market is to make themselves richer. Their only purpose within all moves in the market is to line their pockets with more money. This is simply a game to them all, and we are pawns within their huge games of money chess. Okay, so we've just spoken through a process there, and this process can be applied through everything. You know, we could be looking at this region as a trend line. We know that a lot of people are selling on that trend line, and therefore we know that if we push price through, like we have done once, twice, the push through that potential trend line is going to clear liquidity, because a lot of people will be getting involved in this region, seeing price tap to that level, getting involved in sales before it ultimately blows through. We may also see fake out, in which case we see a trend line like this. Price appears to break, retest, come up, follow back through. Okay, and then we might see something like that again. And what this is, and what a fake out is it's the manipulation of liquidity, because anyone who's looking to sell from the trend line has been liquidated because price has pushed through, hit their stop loss. Now, people who are looking to get involved in the break and retest are executing buy positions, stop loss below that low. Okay, let's now run that liquidity, which is why we then come back down. you will see that if you view the markets from a point of liquidity, that price is constantly building, or the smart money operators, sorry, are constantly building and clearing liquidity on a range of time frames in a range of different ways. But just understand that these fake outs, these fake levels of support and resistance, these concentrated areas of swing points, so consolidation regions, are all just for the purpose of manipulating people out of the market to make dumb money, incur losses, and allow smart money to profit more. But back to the point. I know we're talking about all these things that they do as if they're superheroes, as if it's a very easy process for them to do all this crazy stuff, but it's not quite as easy as it sounds, because all of these processes require the smart money operators to use buy and sell positions or use the power of their own liquidity, because their power lays within the money that they have and the vast amount of liquidity they have to play with. The tools that they have at their disposal is just executing sell and buy positions of different sizes at different times in different orders. That's their tool. That's a tool that they use to do all of this, to move the market in whatever way they want, to manipulate people into losses. All of these crazy things that they can do is simply through the use of buy and sell positions of different sizes, because of course that is all they can do. The market is just selling and buying. But what we must understand is that when they become active and when they execute these positions in order to meet the requirements of what they desire to do in the markets, they leave something called an institutional footprint, or a footprint is left behind. If we learn how to correctly identify these footprints, we can understand which areas in the market hold relevance as points of interest. Let's just go back to the idea of market cycles. And let's even just use one of these swing points as an example. So we can see we've had consolidation, downtrend, consolidation, uptrend, consolidation, downtrend, consolidation. Okay. Now the consolidation is different sizes, different shapes and sizes, as is the uptrends and downtrends. Understand that nothing in the market is ever going to be simple, is ever going to look the same. All phases and all trends and all cycles of structure in the market will always look different, will always come in different shapes and sizes. The point that we're making here is that in these regions of consolidation, what is happening is, firstly, liquidity is being built. And you'll notice if we look at this from a liquidity standpoint, we can see, okay, all of these highs is representing liquidity built up at that level. We have a fake out, push back through, build another level, fake out. We even see the break retest. So we literally are giving a fake out at that level before falling back through. So we've had a lot of market manipulation in this region. So we know that because of that, we've had a lot of institutional presence at this region. Now, the purpose of consolidation phases at the end of trends is for the smart money operators to play around with executing and closing buy and sell positions. So when a downtrend happens, that is because the institutions are opening more and larger sell positions than they are buy positions. When price then enters that ranging phase, it's because they're removing their sell positions from the market, therefore removing supply, and slowly starting to execute buy positions, therefore introducing demand. Once they do that, demand starts to outweigh supply, the market moves up. They've now brought price up as far as they wanted and as high as they wanted. They're now running out of demand. Demand is being exhausted. So what they will do is they'll now close their buy positions that they've profited from and start executing sell positions. So a consolidation phase is the closing of one position and the opening of a new one. If it is a consolidation phase after an uptrend, we know that it is the closing of buy positions and the opening of sell positions. Because in order for a price to move up, or in order for a market to move up, we know demand must outweigh supply, which means the smart money operators must be pumping more lots of buying power into the market than they are of selling power. If they're doing that, it means that they want to profit from buy positions. The second we see a period of consolidation and price starting to break down, that is a sign that the institutions or the smart money operators are starting to slowly remove those buy positions that they were profiting from and start executing sell positions, because they now have the purpose of profiting on the downside. But when they are opening and closing these positions, they leave footprints behind. And what that also means is that when we see manipulations of the market, it requires a process where they have to open a large position, and the majority of the times they don't get to close out in this position. So let me just show an example. We see in this region that what we've had is price has been bought up to clear the liquidity in this region. Now, in order for price to move from A to B, we obviously know that we must have had a uptrending phase to take price from A to B. Within this uptrending phase, the institutions would have to be executing a lot or one large buy position in order to take price from A to B. Now, this buy position obviously will only be in profit if the market continues up from this point. We see though that price has actually come lower. They don't get to close out on this position because this position is a key component within the supply and demand balance and had to be opened in order for the market to be manipulated, in order for that liquidity to get cleared. They had to open that buy position, which is represented by this small uptrend that we've seen. But as prices come down in that downtrend, that position has not been able to get closed. And therefore we can see this as a footprint, a smart money footprint, or a point of interest. We'll go more into detail onto points of interest, how to identify them in the next episode, but that is just understanding why liquidity and supply and demand balance has a huge effect on that. Now, I'm just going to read another quote from the PDF, which says, "It is the correct analysis of market structure, the precise identification of these footprints left over, whilst also the understanding of liquidity and where it lies within the market that will paint a picture for us and allow us an insight into what the smart money is thinking and therefore wanting to do in the future. If we know what they want to do in the future, that means we can be on the same side of the market as them and therefore profit alongside them with the moves that they're controlling. We obviously always want to be on the same side as the institutions. Because of the control they have in the markets, we always want to be profiting alongside them, and therefore we must understand that these footprints are left, identify them correctly, and use them as points of relevance for us to trade around to ensure that we can be getting ourselves involved alongside the institutions and profit with them, rather than being the dumb money who's actually getting manipulated out of the markets from their market manipulations of liquidity. So let's actually discuss that. All of the people inside of here that were getting involved in sell positions, they've been liquidated. They are the dumb money because the smart money operators have cleared them out of positions, made them incur losses whilst all profiting for themselves. But if we were aware that this was happening, we would be able to A, avoid taking those losses where the market manipulations occurred, whilst also then getting involved in the movements that they have backed. So we see in this region, their entire purpose after that uptrend is finished, we enter a ranging phase or period of consolidation. The reason why we have to do that is because that's pretty much where the smart money operators take a break. Okay. After an uptrend, they've just profited loads from all the buy positions they've executed in this region. They have profited loads. They're now happy with the profits they've got. They're now happy with how high prices come or how long that uptrend has lasted for. So what they're going to do is they're going to enter a period of consolidation, which marks the process of the removal of some orders and the execution of other orders. Now, of course, they're not just going to do that in a very simple fashion or make it too obvious what's going on. Instead, what they're going to do is enter this period of consolidation and use that as a great time to manipulate people out of the markets. As we said, typically in these periods of consolidation, there's always going to be clear manipulations. We see that here where we've had levels of liquidity built up, the clearance, and straight after that clearance, prices move lower. We'll probably see this at the majority, not all, but the majority of swing points. Let's just look back at some of those over time and see if we're correct. Okay, level of liquidity built up because of a lot of swing points, clearance, price takes off. And even back over here, level of liquidity built, clearance, price then takes off. What we can now understand is the periods of consolidation, which represent swing points. Okay, so we understand that all of these periods of consolidation are also representing swing points in the market. And we know that a period of consolidation, therefore a swing point, represents a region in the market where smart money operators have executed their positions to profit from. So we know that longer term, in this downtrend, every single one of these swing high points, the smart money operators have sell positions open. In order for that reversal to take place and that swing point to be created, we know that for that move down to happen, the smart money operators had to open large sell positions in this region in order to introduce enough supply to cause that impulsive wave lower. Now, since this trend began, so since Monday the 24th of March 2008, smart money operators have been profiting from sales in this market. And same on the flip side. If we look at all the swing lows in the market, we understand that in order for the swing low to be created and for the correction wave to be formed, the smart money operators would have to execute large buy positions at each one of these lows in order to push price up. Now, of course, we see longer term price trades back down and begins to break them, which means that they aren't looking to profit from these buy positions, because of the fact that eventually they're going to be taken out at break even. So understand, when the market is in a downtrend, that is because the smart money operators are looking to profit longer term from sell positions. They're profiting because at each one of these swing highs, they have sell positions executed. We see that the first one's executed there. Price is now all the way down here. So they're profiting that much from these sell positions, understanding that at the swing lows in a downtrend, they do have positions open, buy positions open, at this region in order to cause that correction wave to be formed, but they're not looking to profit from them. They're simply just a key component in order to deliver the correction wave. A lot of the times, these buy positions may just be taken out of break even as price approaches, and therefore they're not looking to profit from these positions. But what that can mean is that we know now that all swing points represent areas where the smart money operators have opened positions. So therefore, when we look inside of any trend on any time frame, we can begin to understand where positions lay. We understand we could do the same thing if we identified all of these swing points. All the swing highs represent where they have executed sell positions, and all the swing lows represent where they have executed buy positions to create the correction wave. Now, in order for them to execute sell positions at these swing highs, we said that at these swing highs, a level of consolidation must take place. But when we create a period or a level of consolidation, we are also building a level of liquidity. So let's say longer term, we are within a downtrend. We look inside of this downtrend and we know that we have bullishness trading us up. We then have that period of consolidation, but we cannot leave this big level of liquidity because that is a target for the smart money operators. Instead, they're going to clear that liquidity, clear that level before that downtrend then begins. Like so. But what that means is that in order for this manipulation to happen, they've had to open a buy position at this level in order to push price through to clear that level. But as price is then taken off, that buy position still open, we no longer term that they want to profit from sales. So it's counterintuitive for that buy to be open, because as that buy position's open, that is actively adding to the demand in the market. And obviously it's not good for us to have a lot of demand present. So what the market will do is trade back up to these regions, tap into that region, therefore allowing that buy position or that order to be closed. When that buy position is closed, we're now removing from demand, therefore tilting the supply and demand balance more heavily into supply's favor because we have taken away from demand. What this also means is that we can now create a new swing point. When we create a new swing high, we know that the smart money operators are then also executing extra sell positions. So what's happening is we're not only seeing price remove demand from the mitigation of this order, and when price comes back into these levels where a footprint has been left, that's called order mitigation. So not only are we mitigating that order, removing demand from the market, we're creating a new swing point, which means that more supply can be introduced from the sell positions that are opened by the smart money operators at this swing high point. So we see that market structure is all a simple game to the smart money operators. It is a tool that they use to profit. It is a tool that they use to manipulate people at the market, and it is a tool that they use to line their own pockets. Now, we understand that every single buy to sell region where we see prices bought up in order to sell longer term, what's had to happen is for that buy to begin at that swing low, buy positions have been left open. Now, what price has to do is right at this level where buy positions have been opened, price must come back and tap into that level in order to mitigate it. And that's what it's called. In order for that position to get mitigated and for that buy position to then be closed, price must trade back up, create a new swing point, and close that order. Now, this happens an infinite number of times. At every single swing point, there is an order that needs to be mitigated. And what price may do is we might have efficient price structure where we see prices constantly trading back up and clearing those orders as it goes on. Okay, it then trades down. We then see that this is the new buy to sell region from that point. Price may then trade up again. Okay, it's mitigated it. So what we see is that in these regions, each time we've had an order executed, prices come back up so that order can be mitigated. The mitigation of that order, so the removal of the buy position in that region, had to be done through the process of creating a new swing point and therefore opening and leaving another unmitigated buy position, which we've left. Price then come back up to that previously unmitigated position, tapped into it, mitigated it, but the process of the mitigation has left another order unmitigated in the market, and we see the price has to keep coming back to these positions, mitigating them out, and therefore we can use those regions as footprints because we know price should eventually come back to it, and therefore it holds relevance. At times where we don't see price come back to a buy to sell region in the market, we know that that holds relevance, and we can then identify that on our chart and use that as a point of interest. So hopefully this is all beginning to make sense, how the smart money operators control the markets, why liquidity is so relevant, and why swing points as well are very relevant in terms of orders that are in the market. Now, we're actually going to touch into this a lot more in the next episode where we really dive into points of interest, supply and demand zones, all of this stuff. We'll enter that in way more depth in the next episode, but hopefully that has introduced you to smart money very well. If anything inside of this video hasn't made sense and you'd like me to touch on it further, make sure to let me know and I can include snippets in further videos to discuss those topics that may be confusing, therefore shedding more light for you to understand this strategy. So those are the foundations set in this episode. The next episode will follow on from that. Use the foundations we've just learned to touch on the more in-depth concepts of step 2. So I hope you have all enjoyed. If so, please make sure to check out the LAGFX website. If you have enjoyed, make sure to check out all of our socials where we provide tons more free information for you all. But without rambling on, hopefully you have enjoyed this episode and I look forward to seeing you in episode 4.